It is correct to say that a country that cannot control the issuance of its currency loses its sovereignty under the current banking system. This is because issuance of currency in various forms is essentially done by fiat by central banks, and, to some degree, by financial instruments such as derivatives by very large private investment banks. The underlying problem to this is the way the value of a currency is established, which is more or less also by fiat. Fiat money is money that derives its value from government regulation or law. The fact is that money can only represent and have the value of what can be purchased. In other words, the currency of a country can only represent its land and property value and its goods and services products. This is in fact what any currency is really backed by. It is not backed by fiat, by gold, as this is a too limited commodity to represent an economy in the 21st century, and not by tanks either. If a currency were based on a country's land, its property value, and its goods and services products, the country would be able to determine the value of its currency and how much of it could issue. If the euro were based on this, and if it would be up to the single country's treasury to calculate what the value of such country's land, property, and goods and services products were, and to determine how much euro it could issue against this, the euro would work, as countries would maintain their sovereignty and control over their currency issuance while having a multinational currency at the same time. The euro, however, does not work this way, and thus does in fact undermine the self-governing capability of the people of a nation. This would leave two options: leave the euro, or create a currency reform whereby the euro is based on the above formula as calculated by each state, and that euros are issued against those assets, as that is the only true picture there is of any economy. Administratively, a European country would provide this information, and the European Bank would be required to issue euros against this. If there was a dispute, a court could be set up to settle any such disputes. This would require a new constitution for the European Central Bank, which would limit its functions to exactly and only that. Aside from restoring sovereignty to a nation while being part of an international federation, it would also change the banking system from one that is based on creating ever-increasing debt to one that can only invest in increasing productivity, as that would be the only way to increase money volume. This would also affect the IMF, in that its loans to EU member countries would have to be bound by this rule. Loans can only be provided for productivity increasing projects. Interest rates would morph into a percentage of actual increased value, not just increases in mere debt. That would remove the usury element out of the Western banking system.